Happy early Monday morning, folks. It's 4 a.m. and my name is Amal. I'm here to do your morning Bitcoin analysis, and I'm going to cover other markets as well. But today I wanted to share some really good strategies with you guys of how I trade Bitcoin and some of the strategies that I look out for on a daily basis. So again, welcome to the Alpha Trades community where we empower aspiring and experienced traders. So let's get to the analysis. First things first, if you're not subscribed to our YouTube channel, make sure you hit subscribe and make sure you hit the thumbs up button on this video below. The other thing that I want to talk about is we just did a video with the former Citigroup portfolio manager, Austin Ashraf, and we discussed a lot of things regarding the current state of the markets in equities, especially the US markets, what his top stock picks are in terms of longs and shorts, how he sees the economy as well as the markets going forward, and how he sees Bitcoin as well as gold. If you guys want to see those topics being discussed, please click this video and go watch it on our YouTube channel, Alpha Trades. So by the end of this video, you will have two different strategies of how you can look at different time frames and trade Bitcoin. But for now, let's get to the analysis. All right, so first things first, what we see right now is a big sell-off in the hourly time frame right here. We dropped from about $9,800 all the way to about $9,282. This makes sense because the BTC gap, the BTC CME futures gap was right around, I think 93.95 was where the market closed. Where was it? Let me see here. I think the market had closed right there, 93.95. And I think BTC CME traders were actually trying to close that gap because remember the way gaps work is if over the weekend prices move in one direction or another and the CME markets closed at a different price, that gap of when the market closes on Friday versus when the futures markets open on Sunday evening leaves other traders trapped in positions that they don't want to be in. So to cover their losses, they would have to force the market down or up into a particular direction to cover things known as these gaps. So with that being said, these traders have now closed that gap, okay? And for the most part, these gaps have about 85 to a 90% success rate of the gaps being closed in less than a week. So it's a pretty good indicator of trying to figure out, how to trade the market or potentially the direction the market's going to go if and when there is a gap in this CME. So on the 1 hour time frame, what we see right now is a big drop off because again, the market was forced to effectively close that gap, and now we're currently at 95.74. For the last week or so, we've been short on Bitcoin. I have been a big proponent of mentioning that I don't believe that the market is ready to push higher. I think the market is struggling to get past the 10,000 zone unless it actually breaks through with convincing volume above 10,000 and especially 10,500, which is this key marker that comes back from October 2019, February 2020. Unless we break through it right now over the next several days, I don't see why the market should not start heading back down in terms of retracement. I've mentioned in a few videos before why on Trading Light, if you start looking at the amount of sell walls that have popped up, as well as the overall volume, when we start looking at it on an hourly or 4 hourly time frame, there's been a lot of selling activity happening right at the tops of these moves like this distribution right here, big sell-off right there, even big selling right there, big selling right there. So when you have selling right near the tops and the price keeps getting bid up in a grinded manner like this, but again gets sold off, this means that there's someone who's trying to efficiently sell a lot of supply at good enough prices where they don't have to get out at lower prices like 8 or 9 or 7,000 or 6,000, etc. So when you get more people enticed in the price action at a higher price, of course, the bigger professionals and the institutions and the whales can get out at better prices. And also that allows them the ability to load up on short positions at a pretty good price. The other thing that we've noticed in this kind of price action movement is that there was some bullish patterns being created, which was this cup and handle right here. Now this cup and handle could technically still be valid in a sense. Not that this is a valid handle anymore. I guess it could be if you start stretching it out, maybe something like, let's see here. Let's see if we stretch that out a little bit more. So if we do something like this, and let's just say this is your bigger handle that might be being created, that is very possible that this is your bigger cup and handle at play. I personally don't believe so, but it is still technically not invalidated. Now with this cup and handle, remember cup and handle patterns are bullish patterns, and once they do break out, what you typically get out of the pattern is, let's just say if we measure the cup size like that, the breakout right there puts us right around $11,700 from this high to this low of the cup, okay? However, I don't quite believe that BTC is ready for a bigger move to the upside. One of the reasons why I don't believe that Bitcoin is ready for a bigger move to the upside is because if you start looking at the equities markets, let's just say the S&P 500 E-mini futures. So let's do a single screen on here. Let's do the SPX chart, or actually let's just do the ES chart. If we look at the ES chart right here, the one thing that we've seen even in the S&P 500 futures market is that after this big move up, what we've really done is trade in this kind of range right now. Okay, so this has been active for almost a month now. Since April 16th, we've really just traded in this particular range, as you can see in this golden box. And until, I would say, if equities, unless equities break out of their range to the upside, I don't see why BTC is going to break up to the upside anytime soon. Now, with this range trading right here, you might get some, possible opportunities to the upside, maybe 10,000, 10,500, but that doesn't mean by any reason that we're going to push up even higher and higher. So remember that 10,500 is a key marker, and even this key high, I would say 10,085 is a key marker that we need to pay attention to. Until either of these are broken, I would probably say a lot of Bitcoin's movements are predicated upon how the equities markets are going to move. Okay, so I personally still see Bitcoin as a good shorting opportunity. I am still short. I've warned my community that I don't believe that there's good risk to reward even at the current price action. Yeah, you may get a couple $100 out of here, but the risk to the downside is significantly higher in my opinion, and the risk to reward for a short up here is just phenomenal in my opinion. So shorting up here, let's just say 95.75, you could have your stop above 10,500 as a deeper risk stop, or just above this key high right here around 10,085 that we put in on the 7th of May on this green candle. Either case, the downside risk for Bitcoin is at least $8,100, which was this previous low, or below that, which is this consolidation around $7,700, $7,800. So you can see in either case, that's either a $1,400 move to $8,100 or almost a $2,000 plus move down to about $7,700 or $7,500. Okay. Now let's discuss some strategies. On the 15-minute chart, or any time frame pretty much, here are two EMAs that you can watch, okay? The EMAs are important, specifically the 20 and 40 EMAs. So this is strategy number one, okay? 20 and 40 EMA flips. The reason, first of all, we use EMAs is because they're exponential moving averages. They move faster with price action due to their smoothing out of understanding the volatility of the BTC environment. The regular moving averages are a bit more I guess, inflexible in a sense in terms of volatile movement like this. So the EMA moving averages are very useful, or particularly useful in my experience. And specifically the 20 and 40 periods, once you lay those out on pretty much any time frame, whether it's the 5 minute, the 15, the 1 hour, 4 hour, etc., you can get some opportunities for longs and shorts. So for example, okay, if we look at this opportunity right here, right, if you look at this green moving average, which is the 20, the lower moving average is on the top, the 40 is on the bottom, which is the red. If you look at this cross, that cross happened right there, and this is a 5 minute, right there around 7:55, or this particular candle, or let's just say even before that, any of these two. If you just bought this cross as a potential bullish movement, you could have bought it right here as a long position. Once it crosses bearishly, which is right there, you could have sold right there. So you would have effectively captured from here on up about a 2.5, 2.6% move. Now let's just say you went short, okay? So you could go short as soon as you sold out on your long. So you had your first cross, right? Over here, this is all just sideways movement. So I don't know if this was particularly useful when it comes to EMA trading, but you could have said, okay, well, this is all sideways. Once you get a big drop and then you start seeing price for the EMA close or cross bullishly again, you could have closed out right there. So from this area where it crossed bearishly to this area where it crossed bullishly, that was another short position of 0.44%. Now, in a larger sense, technically, these EMAs are only useful when the environment for Bitcoin is a bit more trending, okay? It doesn't really help when there's a whole lot of chop like this happening. For that, there's actually a different strategy, okay? And it's slightly different because what it really does is it utilizes price action, and we call it the VWhap, which is volume weighted average price, okay? So what you could do is you could turn on this VWhap right here, okay, VWhap, and you could go into the settings, you could go to the inputs, you can change this to session or week or month, year, decade, whatever. Session is useful if you're trying to get in and out of quick scalps, all right? So if you look at this, even in sideways, ranging environments, right? What you can technically do is once you see the price going below the VWhap, kind of like that, if the overall environment is a bullishly trending market like this one, right? So this is clearly a bullish upside movement trending market. Okay, if you look at it from the 5 minute time frame, right? And again, I don't advise any of you guys to utilize the strategy, especially in scalps, because it's a very dangerous one, because people like to tend to use high leverage or a lot of margin. This is just a strategy I wanted to lay out to you guys, just in case you feel like utilizing some different strategy or something that you have not been particularly working with, but you want to try something new. So if you look over here, right, if you catch the movements to the downside below the VWhap, okay, you could use those as potential long positions, buying down here, or even break below the VWhap, and then selling once price gets above the VWhap right there, okay? And if price again comes below the VWhap, right, once it starts moving aggressively above the VWhap, you could sell your longs up there. Alternatively, you can say once price is well above the VWhap, right, you could short right there, short it when it starts touching the VWhap again, right in this area. So these are the two strategies, the 20 and 40 EMA flips, which again are useful on pretty much any time frame, and then the VWhap session flips, again, which are also useful on any time frame. The reason why I wanted to share these strategies with you guys is I see too often that traders are trying to look at 5, 10 different indicators, trying to figure out, hey, what does this buy signal tell me to do, and what does a sell signal tell me to do, and utilizing it on 1 minute charts. I personally think that's a very dangerous way to go about the market. The most money is typically made on longer time frames, first of all, and also, more importantly, understanding the trend of the market. Okay, understanding the trend of the market will also give you better opportunities for scalps in the internal movements. All right, so you got to be able to understand the technicals, which is, again, technicals is the language of the market. It's the charts that are showing you what's happening behind the scenes. Each of these candles represents an individual buyer and a seller trying to figure out if this asset is worth more or less at present prices. Is the market overvalued or undervalued? Is there too many people in terms of demand versus supply? These are all things that are factored into the markets, and they are described by each one of these candles that you see. There's a reason why each of these candles are printed the way they are. Okay, so technicals themselves is very useful when you actually understand the context of what's happening in price action. If you kind of just look at the price and think that every candle is a buy or sell, you're never going to succeed at this market because you're not trying to understand the intention of the movement behind that. Once you start laying out the technicals with the horizontal levels like we do, once you start understanding why volume is useful, once you realize why RSI as a momentum indicator is useful, why specific levels in terms of horizontals are useful, then you start realizing the market is showing you literally what direction it's trying to go into. It will not show you exactly, hey, I want to go up or down, I want to go to this price or that price, but it will give you a good enough indication whether it's trying to show you that the buy side momentum is exhausting or the sell side momentum is exhausting. Volume is saying that there's a lot of supply or a lot of demand. The candles themselves are showing you that they're thinning out. The horizontal support and resistance levels are holding or breaking. Again, the language of the market is really what you want to pay attention to, and that is the technicals, alongside of, if you start looking at the volume, start utilizing the strategies that I mentioned of the 20 and 40 EMA flips. These are all things that can be used in complement to be a successful trader in this market. If you willy-nilly always just start pulling the trigger on trades without knowing what a proper game plan is of when to enter, exit, take profit, you're never going to succeed at this market. So before you even enter a trade, first of all, you got to understand what strategy you're going in with, where you're going to enter, why you're going to enter, what your risk mitigation plan is, which is where's your stop, where you're going to take profit, should you even enter the trade. These are all things that you need to consider before you get into the market and think that you're just going to hop in and try to make some money. Okay, so these are all things that we discuss in the Advantage community. If you're interested, hit the subscribe button below. There's also a Discord link below, or you could sign up on our website, which is also in the YouTube description. I hope this analysis was helpful. Again, I still do believe that the market is a bit more stretched out to the upside. I think it needs a deeper retracement. However, if we start breaking through this EQ level right here of 89.25, more than likely we're probably going to go down here to these lows of about $8,400, $8,500. If we start taking out these lows, I'm fairly confident that our slide into the 7,000 level, $7,500, $7,600, will be pretty swift. But we don't need to worry about that right now because the bulls so far still have shown strength, that they are holding up this area. It's really up to the bears to prove that they have the upper hand, and they're going to force prices down into the lower 9,000 levels and into the 8,000 levels. All right, well, I hope this analysis was helpful. Again, hit subscribe, go check out our YouTube videos. Make sure you watch this discussion with the former Citigroup portfolio manager. And until then, y'all take care. Make sure you keep your stops tight. Hit the thumbs up, and I'll catch up with y'all soon. Cheers.